Okay, so let's get started. I think everybody's here. Look, thank you very much, everybody, for joining us today. This is the presentation of the findings from Workstream 4 of the DFI Transparency Initiative. So this workstream focused on the value of investment, mobilisation, and the structure of the deal. A couple of housekeeping items. Firstly, just to say I'm joined by a number of colleagues from Publish What You Fund today, including Farzana Ahmed, who is our project manager for this initiative, Paul James, who leads the research and he'll be co-presenting with me, Ryan Anderton, who supports Paul, Sally Paxton, who is our US representative, and Jason Alford, who is our strategic advisor for this project. We will, hopefully you can see that we are recording this webinar from the start, and we'll be posting the resulting video on our website. You should all have received a copy of the accompanying report. Sorry if you haven't, I think everyone has, but a final version of the report will be posted on our project webpage later this week. If you do have any questions during the presentation, please feel free to put them in the chat and we'll try and pick them up at the end. If you'd like to speak, please say so in the chat and we'll try and give everybody a chance to do so. We also welcome questions and feedback by email afterwards as well. So Paul and I are going to be presenting. We'll be speaking for around 25 minutes and then we'll make sure that there's plenty of time for Q&A at the end. Okay, Ryan, can you move us on, please? Thank you. So today, as I say, relatively brief presentation, give a quick introduction for those of you who aren't familiar with the DFI Transparency Initiative, and then I'll hand over to Paul, who will talk us through the methodology, the findings, overall kind of conclusions of what the research is telling us, and then we'll talk a bit about next steps, and then, as I say, leave time for the questions and answers. So, okay, so the DFI Transparency Initiative. So a 2.5-year project looking at the use of public money by development finance institutions towards the achievement of the global sustainable development goals. It's very much a collaborative project. You'll see later on, we've tried throughout this work, either with our project advisory board that oversees the whole initiative or with our expert working groups who contribute to each work stream. We've tried as much as possible, not only to collaborate with DFIs and include their staff, both at a policy and a technical level, but also with a broad range of stakeholders. Our approach is evidence-based and multi-stakeholder, as I said, and it's really in two main phases. So we're coming towards the end of the research phase now. That will, in total, will have been about 18 months of the work. So that's conducting these landscape analyses, trying to understand what the DFIs themselves are disclosing and what the current practices are, but also speaking to stakeholders and understanding what information is valued most and what people want. And then we're moving slowly into the advocacy phase. So this is very much talking with shareholders and decision makers on how we can improve DFI disclosure across the entire sector. A couple of sort of notes. One is that the research that we're presenting today, as with the previous 3 work streams, doesn't include financial intermediary investments. The reason for that is we have an entire work stream 5, which is currently underway in the background, and we'll be presenting those findings later this year. We have an entire work stream devoted to financial intermediary investments. We're aware that they're often a very large proportion of DFI portfolios. We're also aware that they often attract criticism for not being particularly transparent. So we wanted to dedicate a lot of time to make sure we understand them and make sure we report on those separately. That report will be out in a few months and we'll do a webinar again. And then the final thing I'll say is that for now, the anonymization of the results is purposeful, and it was intended to highlight what we see as opportunities for sector-wide reform across the whole DFI sector, bilateral and multilateral organizations, public and private portfolios, rather than focusing at this moment in time on sort of individual institutions and how they're performing. In terms of the project, as I say, it launched in late 2019. We've spent the bulk of the time since then building relationships with various stakeholders and conducting the work streams, the research, and we're just moving on to the kind of advocacy phase as we speak. We will be producing the project's sort of final report and recommendations around September, October time. So as I said, there are a number of work streams that we've been conducting research around. So this is the fourth. The first was on basic project information. The second was on impact management, objectives, theories of change, and impact data. The third was on environmental, social, and governance and accountability to communities. The fourth is why you're here today, for value of the investment, mobilization, and structure of the deal. And the fifth is financial intermediaries, but also offshore financial centers and beneficial ownership. For the first three work streams, you'll find webinar recordings like this and the reports themselves on our project webpage. So as I said, for the project, there's an overarching project advisory board that meets every quarter, helped us identify the kind of core areas and work through to develop the work stream concept with us. But for each work stream, we then have an expert working group. So these are individuals who have deep technical expertise in the specific area that we're looking at during that work stream. And they come together at the start of the work stream to help us identify specifically what we should be looking at as we're building this matrix to assess the disclosure practices of DFIs. And then they come together at the end to help us sort of analyze the results and think about what opportunities or what barriers remain to better transparency. I should say that their presence on the expert working group is not necessarily an endorsement of our findings. We're an independent campaign for aid transparency, but we are very grateful for their input into this work. So this work stream assesses the transparency of the ways that DFIs structure financial aspects of their direct investments. And of course, this is important. If we want to look at value for money, we recognize that resources are constrained more than ever, arguably now. We really need to understand how these deals are structured, which partners are involved, and what impact they're delivering. So DFIs are an important component in scaling up investment in developing countries. We recognize that. And that's why this work stream has focused on a number of areas where we think DFIs can do that most effectively. So that's partly through provision of concessional finance. It's partly through mobilizing extra resources from private organizations. So timely, systematic, and standardized disclosure of financial information would allow DFIs to have a powerful demonstration effect in the markets they work in. And throughout this work stream, as we've talked to a variety of stakeholders, the repeat message we get from impact investing organizations, large and small, is market information is essential for them to be able to bring more financial muscle into these markets. So there are a number of reasons why this work stream specifically, the information is so vital if we're looking to bring more resources into these markets. And as I say at the bottom, it allows private investors to understand market conditions and opportunities for investments. That's a message we hear over and over again, and I think we're all interested in bringing more resources there. So I'm going to hand over to Paul now to take us through the methodology and the results.
Thanks a lot, Gary. So as a brief overview of our approach for this work stream, the working paper has been informed by a landscape analysis, which was essentially a manual survey of 17 DFI portfolios. I should note these were all non-sovereign portfolios, so they were private sector investments made by DFIs. We surveyed a total of 172 investments. The original intention had been to survey 5 of each of the main types of investment we looked at. So 5 equity, 5 debt, and 5 guarantee investments for each of the DFIs involved in the survey. However, this kind of leads to the first transparency question. We found that in 33 cases, we couldn't accurately identify the type of instrument used. So we adapted the sampling to reflect this. So the table on this page gives a breakdown of the types of projects we looked at. The research was further informed by interviews with DFI employees, CSOs, private sector stakeholders, and other experts in this field. And we conducted 2 meetings with our expert working group to discuss the landscape analysis and the draft paper. We move on to the final. First of all, the DFIs. So this is a list of the DFIs which were included in our analysis this time. As you can see, we looked at bilateral DFIs, including CDC, DEG, FMO, and Norfund. And we also looked at multilateral DFIs, some of which are purely non-sovereign in their operations, such as IFC, IDB Invest, and ICD. And we looked at the non-sovereign operations of multilateral DFIs, which do both sovereign and non-sovereign financing, including the African Development Bank, the Asian Development Bank, and the Asian Infrastructure Investment Bank. When we think about the definitions, we used broad definitions to measure disclosure at this point. The reason for this was there's currently a lack of standardization within the sector, and if we'd used particularly tight definitions, then arguably we'd have found even lower disclosure than our results currently show. So just to give you a broad idea of what we were looking for under some of the terms, when we talk about co-financing, essentially we were looking for the identification of third-party investors in the same deal. So that's investors other than the DFI who's disclosing information and the client who's receiving investment. For concessionality, we are talking about investments that are made below market rates. Effectively, concessional finance represents a subsidy to the private sector client. And for mobilisation, we're talking about the stimulation of additional financing as a result of DFI investment. Now, mobilisation can cover a broad range of other parties, so it could be the mobilisation of other DFI finance, or it could be the mobilisation of private finance. So we look to measure both of them within our landscape analysis. So if we move on to the findings, first we will look at the project level or activity level data. This table gives you the overall view of the data fields we looked at activity level across our landscape analysis. As you can see, it is split into essentially 7 different themes. The first of these is the general activity, and then we move for co-financing, concessionality, mobilisation, and then 3 instrument-specific themes which look at questions around equity, debt, and guarantees or insurance. Our broad findings are that there was reasonable information under general financing details, although this was rarely complete for any DFI. And then there was decreasingly less information as we moved to our themes. So we found some disclosure of co-financing, very limited disclosure of concessionality and mobilisation, and almost no instrument-specific information. And we're now going to zoom in on each of these themes quickly to dig into a bit more of the detail. When we talk about general financing, we looked at total cost, DFI contribution to an investment, the type of instrument used, whether or not an investment was a repeat investment, and the currency of the investment. And as you can see, this was the most disclosed of the different themes we looked at, and the DFI contribution is perhaps unsurprisingly the most commonly disclosed, although it should be noted that this was not actually disclosed in all cases. This is particularly important because if you can't tell how much a DFI has spent on a particular investment, it makes it very difficult to make firm judgments about the value of investment and the true impact of an investment. Total cost was only disclosed in a minority of cases, and as I noted in the methodology earlier, there were over 30 cases where we couldn't actually confidently identify what type of instrument was used. Repeat investment was very rarely noted. This is of interest to us because essentially we were looking to understand whether DFIs are helping markets form, and therefore whether they're crowding in other finance. And an indicator of this could be that DFIs have worked with a client once and then it is graduated to more traditional private sector financing. So understanding whether clients remain reliant on DFIs is important, but unfortunately this data was poorly disclosed. So if we move on to co-financing, what we looked at for co-financing was essentially, first of all, a confirmation, a yes/no question about whether co-financers were present in a deal. And then we looked for details of who co-financers were, and then asked whether we could find out the amounts of finance which co-financers contributed to a deal. As you can see, this wasn't disclosed systematically for any of our DFIs in the sample, but a number of them disclosed it in some cases. This highlights one issue with the lack of systemization, is that it is possible that what we are looking at is this information is disclosed in the present when co-financers are present, but there's a lack of acknowledgement when there is no co-finance, and a lack of standardized disclosure makes it very hard to make this call when you're looking at the data. I think one thing to note here, and this more detail on this is in the report, is that the orange in these tables hide some pretty low figures. Confirmation of co-financing was found in less than a quarter of the projects we looked at, and only 1 in 8 or 12.5% provided comprehensive details of who co-financers were, and less than 10% provided information about the amount of co-financing involved in a deal. And so if we move on to concessionality, we looked at two things when we're talking about concessionality. The first was, is there an amount calculation for the amount of concessionality used within a deal? And the second was, is there a justification for the use of concessionality? As noted before, concessionality essentially implies a subsidy to a private sector client. So we feel this type of disclosure is important because taxpayers and shareholders have the right to know when and why public sector money is being used to subsidize the private sector. Additionally, other private sector firms in developing economies arguably have a right to know when competitor firms are able to access concessional finance and the effects that might have on markets through things such as pricing distortions. As an overview of the results, we found no disclosure of concessionality across the bilateral DFIs in our survey, and we only found disclosure from 2 multilateral DFIs. Now, one of these DFIs discloses concessionality amounts and the justification for all of their blended finance projects, while the other makes statements surrounding the use of grants and technical assistance on a concessional basis in some of its investments. So if we move on to mobilisation, at the activity level, we split the mobilisation, first of all, to ask whether or not private finance was mobilised, whether or not DFI or other types of ODA were mobilised, and finally whether figures on the amount of finance mobilised was disclosed. And in doing this, we hope to capture each of the elements of mobilisation relevant to this. This is particularly important in our mind because one of the central roles of DFIs is to increase the inflow of finance to developing economies. Although there's been a lot of debate around the term, one of the kind of central drives of development in recent years has been the billions to trillions agenda. So accurately identifying in what types of projects DFIs are actually increasing private finance and mobilising private finance is key to understanding this. And unfortunately, at the project level, we found almost no disclosure. As the table shows, it's almost entirely red. One multilateral DFI disclosed the mobilisation of extra DFI finance in a single project, and 3 projects from multilaterals included some mobilisation data of both private finance and further DFI finance. But this represented single figure percentages in terms of data coverage across our sample. Very quickly, we'll look at the 3 instrument-specific data together. As you can see, there's again a lot of red here. We found a single investment which included equity shares, so how much of a company a DFI investment had purchased. The most commonly disclosed data field we looked at from instrument-specific fields was the loan tenor or the length of loans. But we found no information around interest rates or disbursements. And again, information was very limited when we looked at guarantees and insurance. So if we move on to aggregate data, This is spread across 2 pages. But to give the headline findings, we found quite a significant amount of aggregate data from DFIs. This was found on a variety of sources, and these sources included financial statements and annual reports. But I guess one of the headline findings was that there's a lack of consistency. So different types of data were disclosed by different DFIs, and it was quite hard to identify where this data would be particularly comparable. I should probably say at this point that as Publish What You Fund, transparency organisation, we believe in the value primarily of disaggregated data, and therefore we're not going to pay too much attention to the aggregated data here. And we feel that if you could get the disaggregated data disclosure correct, then obviously aggregated data would follow. Analysts could essentially draw their own conclusions around aggregated data. A couple of other findings in terms of the aggregated data which I want to quickly draw out. One was that it's often disclosed in fairly in formats which are difficult to use. So for example, numerous types of data we found around approvals and around disbursements were actually disclosed in things such as infographics, which, although are technically transparent, as I say, the usability of them from a research perspective or an analyst perspective is fairly limited. Possibly the topic most salient of the discussion today, and therefore we're going to zoom in on it, is the question of mobilisation. As I've said, mobilisation of finance is a key remit of DFIs. And essentially what we looked for here was 2 sources of mobilisation reporting. So the first was own reporting, which included the MDB joint report, which is published biannually. And then we looked at reporting via the OECD survey. All but one of the multilateral DFIs in our analysis reported to the MDB joint report. So that meant that you can see portfolio level mobilisation disaggregated to the regional level. And we've noted partial disaggregation to the sector level to reflect the fact that they report the mobilisation within the infrastructure sector, but not other sectors. The bilateral DFIs do not individually report to the MDB report. It should be noted that the European DFIs report as a group under the EDFI organisation, but as we cannot identify the contributions from the individual DFIs, that was marked red. However, 3 bilateral DFIs independently report their own mobilisation. As you can see, the majority of DFIs within our sample report to the OECD survey. We'll talk a bit more about the differences between the OECD survey and the MDB reports later. But again, essentially what we find with the OECD survey is there's limited levels of disaggregation, which limit how useful this data is. So if we move forward from this, we'll talk briefly about what the research is telling us. And the first kind of headline finding we have essentially is that there's inadequate disclosure of both aggregate and disaggregated financial information across the DFIs. The key inadequacies centre on the lack of systematic and standardised disclosure. It can be difficult to tell whether certain aspects of a deal are present or whether they simply haven't been disclosed. Across most data fields we've looked at, there are examples of good practice which show that each of these data fields typically can be disclosed. And ultimately, better, more complete disaggregated data is key here. Aggregation could follow good quality disaggregated data. Increased FDI in developing economies is reliant on improved financial transparency and market information. As Gary noted earlier, numerous private sector operators we spoke to told us things such as, there's no such thing as bad data, but a private investor will not enter a market they do not fully understand. discussions with other stakeholders has indicated that a lot of this information is available in very dispersed sources. So often clients will disclose pieces of this information and other sites will disclose parts of this information, but it's time consuming and inefficient to have to source information in this way. If a central function of FDIs is to improve financing within developing economies, then they can contribute to a more efficient transfer of knowledge and a clearer understanding of how markets function if they improve their transparency. Our paper notes that there are some key definitions which in the long term would benefit from alignment. In particular, we looked at competing definitions around blended finance and around mobilisation. In both cases, there are prominent definitions put forward by the OECD and by a group of MDBs, and these definitions are not translatable immediately. This creates problems for the usability of data and the comparability of data. However, we do feel that as a first step, this should not be a barrier to increased disclosure. If DFIs were to disclose their data with a clear statement about the methodology they are using, this would be an important first step as we work on a kind of longer term goal of alignment of definitions. And finally, we have been talking about identifying appropriate levels of aggregation in cases of legitimate commercial confidentiality. Now, commercial confidentiality has been a recurring theme throughout our work streams, and in a lot of cases it has been challenged. There has been an assumption of commercial confidentiality, we have found, and there are examples of when this has been challenged. The resistance to greater disclosure has been less than expected. We will come on to an example of that on the next slide. But in the meantime, we feel that we could provide some level of guidance, and we were in discussions about doing this, about how useful levels of aggregation can actually allow the anonymization or the effective anonymization of commercially confidential data and still provide meaningful market information. So when we talk about opportunities for increased transparency, some of what we're looking at is good practice at the moment. And one which particularly stood out and we featured in our paper was IFC's disclosure of concessionality, which began in 2019 with disclosures surrounding the amount of concessional finance in their private sector window programs. This marked a kind of step change in the DFI community. It was as we understand it, the first example of the DFI making an attempt to quantify the amount of subsidy involved in concessional deals. This has since been expanded by IFC, so now they apply this to all of their blended finance projects, and it gives an indication of the ways in which blended finance or concessional finance can be used to make deals happen that would not otherwise happen. So it has a powerful kind of learning element to it. We do recognise that different DFIs invest in different ways. They have different modes of operation, and the IFC's model won't necessarily work for all DFIs. So as with the definitional question above, there's an argument that a first step would be for DFIs to define their own concessionality or lack thereof of concessionality, and then apply their own methodology and disclose an argument of what they feel their concessionality within a deal is. A number of interviewees we spoke to suggested that disaggregated mobilisation information would represent an important next step in disaggregated disclosure. It was argued that this was less commercially sensitive than concessionality and that the barriers to achieving this were low. As we saw in the aggregate data, DFIs are already commonly reporting aggregate data, both to the MDB joint report and to the OECD survey. So the assumption is that there is disaggregated data lying behind this aggregated data, and this raises the question about why it cannot be disclosed. one question is the use of this data, and I guess the argument here is that when we talk about aggregation, then it's been given to you at predetermined levels, and if you are looking to enter a market, for example, and you want to know how a particular instrument performs against in a particular sector, then you need the disaggregated data to run that type of analysis rather than relying on already semi-aggregated data for this. So disaggregated data really represents the gold standard. And then finally, we want to very briefly note some developments with the GEMS risk database, or the Global Emerging Markets Risk Database. The GEMS database is the largest data set concerning risk and default rates in developing economies. It's contributed to by a community of DFIs, including EIB and IFC. And as we've noted, like, understanding risk is hugely important for the private sector. So if DFIs want to stimulate further investment in these economies, as the custodians of the largest data set on risk and default rates, they're in a unique position to improve market information in this particular way. We do note there's been a recent publication from GEMS, which we believe is the first public disclosure that the database has made in its 12 years or so of existence. This is to be welcomed, but we'd like to see this as the beginning of a trend and kind of further disclosure to follow from this.
Thanks, Paul. So in terms of next steps, so as we said earlier, we're open to feedback. If you've had a chance to read the report, if you've got questions or comments now, we're happy to take them. But we're kind of wrapping up this work stream over the course of the next week or so, putting the final version of the report on our website. As I said earlier, we are currently in the background undertaking research on Workstream 5, Financial Intermediaries, Offshore Financial Centres and Beneficial Ownership. If there's anyone that wants to talk to us about any of those issues, please feel free to get in touch with us as we're undertaking that work. And our transparency recommendations will be launched in September, October this year. So what we're seeing, as with the previous 3 work streams, with this work stream, we came up against similar challenges. We're finding that basic information related to the work stream is not being made publicly available. When it is made available, there's no kind of systematic disclosure, meaning you find inconsistencies within individual DFIs, and that comparability between different DFIs is made pretty much impossible. And yet we saw the opportunity. We saw that there are always instances where individual DFIs have found ways, either through negotiations with their investees or other means, to make information available. So despite those large swathes of red on the research that Paul just took us through, you'll always find an orange or a green box for every piece of information that we were after. As with previous work streams, this work stream has raised a whole bunch of questions. We talked through the value of this information, and I think it's worth reflecting. If it makes you ask the question of whether DFIs are actually having these discussions about transparency with their investees at the outset of investments to help overcome commercial confidentiality barriers. It makes you wonder, whether without this information, how do we know if we're on track regarding mobilization? We appreciate the work that's done by groups like Convergence and think tanks and so on, analyzing the data on blended finance and other efforts to mobilize funding. But we also know from those same groups how desperate they are for more data as well. There's questions around concessionality. How do we know if the concessionality of DFIs is building or restricting markets without some of this information? Paul made the point earlier about repeat investments. That should be a not particularly scientific, but a useful bellwether to tell us whether we keep investing in the same mechanisms and investees over and over again, rather than bringing the private sector in to take on those as they've matured. Are we holding back vital market information that could incentivize capital markets to redirect funds to developing economies? You know, fundamentally, how do we know what works and what doesn't? How do we know if we're taking the right approach to risk? We know that DFIs aren't investing enough in low-income countries at the moment, yet because this data isn't there, it's really difficult to learn from those DFIs that have made investments in such frontier markets. So in conclusion, at a time when we're seeing such an enormous financing gap and resources becoming increasingly stretched by COVID and other challenges, it feels like the least we can do is open up our data to enable analysis, learning, and targeting of our remaining resources where they can make the most difference. So we're now going to take some questions or comments. So please feel free to put them in the chat. We recognize that this is a particularly technical and heavy work stream compared to some of the others that we've undertaken. As I say, if you haven't had a chance to read the report, please do that in due course. Please always feel free to get in touch with us. I'm going to take a question that we've got in the chat here. It says, your findings on the lack of disclosure on concessionality and mobilisation are very important. Can you outline how you are bringing these results to DFIs? And are you suggesting there should be a harmonisation of reporting across the DFIs? And is this achievable? So we've been so the first part of that question, how are we bringing these results to DFIs? So we have shared this information with the main DFIs that we engage with, and beyond the expert working group that we put up on the screen for this work stream, we also have conversations with a bunch of other staff from DFIs. So they're very aware of what we're doing, they're aware of what we're finding, and we do, that's a useful counterpoint for us to help us understand why information might not be being disclosed, but also we want to check that we're actually assessing everything that's out there. So the DFIs are very familiar and have been made aware of our reports. In terms of harmonisation or a way forward, our recommendations will be coming out in September and October, and what we're currently working on is establishing a kind of reporting framework for DFIs, which would essentially break down, you know, through this work and what we've presented today, you'll see that there's an awful lot of fields that we've looked at. But what we want to do is really break that down into what are the key fields that we know are particularly important for various stakeholders. How would we define those fields in detail to make it very clear what stakeholders would expect? And can we turn that into a kind of a document that would be a form of guidance against which DFIs could disclose information? So we are currently sort of working that through and figuring out how that might look and what might be included on that. And we're in discussions with DFIs about that as well, about how, and what we do know is that a number of the leading DFIs find that have said that this would be useful for them as a kind of a clear piece of guidance to tell them at a granular level what kind of information would like to be shared and what format and so on. So we're keen that there will be some uptake of this, but at the same time we recognise that this will require the changes in a lot of practices and systems, and particularly we've spent a lot of time talking with legal representatives from DFIs to understand the contracting process, the commercial confidentiality issues that arise, but also talking to impact investors who have managed to overcome some of these barriers. So we've got examples not in this report, but in the Workstream 2 report on impact. We've got examples of how impact investors have been able to adapt a non-disclosure agreement document to ensure that it's known from the outset and it's negotiated with the investee that certain information will be made publicly available in that case on impact data at a later date. So that's the rough sort of plan, is to continue engaging and collaborating with DFIs and a wide variety of stakeholders, and then towards September, October time, produce this framework which will provide guidance and then seek adoption of that framework for reporting, recognizing that there are a lot of reporting frameworks on various issues that our work has covered, and trying to make sure that we're kind of harmonized and not overlapping with too many of those. The final part of your question was, is this achievable? Where there's a will, there's a way. We look at as Paul mentioned, the discussions that we've had, there are certainly some information that DFIs have outright said that we shouldn't expect it at a granular level. there's nothing that we've been told we shouldn't expect at an aggregated level. We are working on this aggregation guidance so that rather than a DFI saying, here's our figure, let's say on risk, here's our figure for a whole continent or the whole planet, we might be able to break it down to a better level of maybe sector or region or even country, depending on the number of investments. So we feel let me stop there on that question. Okay, there's a second question. It would be interesting to hear if there were any further insights when reviewing different mobilization reports, e.g. OECD and the DFI mobilization reports. How comparable are they at convergence? We see the different definitions of blended finance, concessionality, and mobilization as a significant barrier to the field. So I'm going to hand over to Paul for this. But just before I do, we recognize that it's definitely a barrier. But as Paul mentioned in his research, we think that efforts should be made to harmonize and to align and to make these things more streamlined for purposes of learning and comparability and analysis. However, what we've also recognized is that there's many instances where information just isn't made available in a basic form, just telling us what approach the DFI has used to calculate those numbers. A bit like with our impact workstream, where we didn't make a judgment about what was a good way of measuring impact and what wasn't, but we did expect transparency around how the DFI measured its own impact and what indicators it used, what definitions it used. So this is just to provide some balance to say that our view is, yes, these are barriers, but at the same time, there's plenty that can be done in the meantime by DFIs in terms of how they share information at a granular level and an aggregated level, and just telling us what approach they're using before we achieve alignment. Paul, can I hand over to you on the start of the question?
Yeah, thanks, Aisha, for the question. I think talk about how comparable they are. If we look at mobilization, interestingly, sometimes the figures don't look hugely different. So if like CDC are a DFI who disclose portfolio level mobilization for both the OECD method and the MDB method on an annual basis. And their 2019 data for OECD was approximately 880 million, and for the MDB approximately 920 million. So the figures don't look hugely different, but one of the key problems with them is you cannot make a comparison between them, and the fact that the definitions are different means there's no simple calculation you can make to convert one figure into another. So the MDB definition, for example, includes both direct and indirect mobilization, whereas the OECD method doesn't make this distinction. And then the OECD method requires essentially proven causality. So it requires something such as the evidence of syndication fees with a loan. So essentially, you really are counting two slightly different things. So comparability between the two sets of data is more or less impossible. As Gary said, efforts towards harmonization in light with this, as with many other issues around the impact of DFIs, for example, has been kind of ongoing for a long time now. So I think we'd really emphasize that a good first step is clarity around the definitions you're using, and then data disclosure according to that. Or if possible, what CDC have done at an aggregate level, where they have actually disclosed according to both methodologies in the same place. So, that represents a major part of the kind of mobilization picture then.
Thanks, Paul. There's a comment here. It says, for your information, a joint MDB OECD working group was set up in 2019 to work on solutions to address confidentiality concerns expressed by some MDBs when reporting on mobilization to the OECD. A data tool is currently being discussed to disseminate semi-aggregates and will be live soon, at least for bilateral DFIs mobilization. I'm not sure if we knew about that. Did we know about that? That could be useful. If you don't mind, we might get in touch with you about that. to learn more. But yeah, and that's something else that's been welcomed by a number of DFIs when we've talked about this kind of guidance on aggregation and trying to come up with a relatively straightforward rule set that helps you determine to what level of aggregation you should be sharing data if you can't share it at a granular level. Okay, let's, I think we are through with all of the questions. There's one more comment. This says DFC, so this will be the US Development Finance Corporation, reports on both private and sovereign capital mobilization in its annual report. Details are given by region and in total. Paul, I don't know if you want to respond to that or make any observation.
It's difficult to respond to it without de-anonymizing the results, I think.
Okay.
I think they
yeah, so and what we'll try and draw out in our final sort of recommendations is we'll try and draw out the varied practices so that people can see which kind of organizations are leading the way using kind of what approaches for their disclosure. Okay. One final question. Sorry if you've already addressed this, but what role can the GIN, so the Global Impact Investment Network, play in assisting with uniform and transparent data? So I know, Paul, that we had discussions with the GIN team a couple of times, but specifically during the impact work stream. Is there anything you wanted to say about? We know that on the impact measurement side, they've obviously been leading the way on harmonizing and standardizing the reporting. Is there anything you want to say, Paul, about the potential for GIN to collaborate on broader issues such as this financial structuring?
It's a good question. I'm not. I'd say, as you say, we spoke to them about when we talked about impact, but I guess we haven't really dived into kind of their links to the more financial structure side of things, and that is something we could certainly look at to see whether, particularly they've done a lot of work on alignment, maybe there's scope to look at how their alignment could help inform alignment of definitions within the financial reporting too.
Yeah, and the framework that we're developing as well, we'll be looking to share that with a range of stakeholders as well, and I can imagine that the GIN team would be involved in that as well, to make sure that we've captured the main things and that we're not overburdening on the reporting front. I've seen a comment saying, oh, okay, so I think it's the case that if for people who are asking questions, that only the panelists can see the question, not the attendees. So as a result, the earlier question on MDBs was not, one of the attendees can't see it. So I'm not sure if this was the question. We'll try and find a way of sharing it here, and if not, when we follow up, we'll put it on email. Is this appearing here? No, okay. Oh yeah, so it's now been posted to all panelists and attendees, so everyone should be able to see that. There is a comment here. The fundamental problem is that the incentives to disclose information lie outside of the DFI's MDBs with private sector investors and development finance providers. Disclosing information may undermine their own strategies and investments. Can you talk a bit on how to align incentives within DFIs and MDBs to disclose information? So I think it's recognized within a number of the MDBs that we've talked to that if they truly want to fulfill their mandate of bringing private finance into these markets, that an element of that is going to have to be having a progressive disclosure policy to build these markets. I mean, it's becoming evident from many of the impact investors that this is a frustration and that it undermines DFI's efforts to build markets. I actually think there are a number of DFIs that want to also show themselves as not only leaders in transparency, but leaders in the practices that they undertake by being more transparent, so showing that they actually do thoroughly. We found this on the environmental, social and governance workstream, for example, that there are some DFIs that know that they invest time and money and systems into doing ESG well, and they want to be able to have that reflected through more transparency. But you know, the more people we talk to, the more we see this demand. We see it amongst shareholders, and that could be board members, but it could also be government authorizers who oversee contributions to DFIs. We've had instances where such shareholders have vented their frustrations to us that they don't get the information they want, and then and that comes with a certain amount of risk as well. We've seen instances where a lack of disclosure has led to uncertainty or confusion about what DFIs are actually doing. And there's certainly, we feel that there are definitely opportunities. There are definitely a number of organizations that see the benefit of having a sector-wide sort of disclosure practice to allow comparability. And the truth is, if we're competing over, if the DFIs are competing over their transparency, then something's gone fundamentally wrong. If investees are saying we won't accept this concessional finance from you if you make us disclose information about the deal, then you've got to ask yourself what whether the DFI is actually adding value in that market, or whether the investee should be looking to get its funding from a private source. So I think there's a whole bunch of areas where DFIs are looking to become more transparent, and I don't think it's going to be a huge push. I think we've listened carefully to many of the arguments around commercial confidentiality. I think we're trying to find solutions for some of those. But yeah, I'm reasonably positive that we'll get movement. Okay. Look, thank you. That was more comments and questions I thought we might get for this particularly technical work stream. So thank you very much. I think we should wrap it up so everyone's got time for a cup of tea before their next meeting. I'm sure we will have another Zoom in 5 minutes. So look, thank you very much, everybody. Please get in touch with us. Any comments, questions, reach out to the team. We appreciate it, and look out for the Workstream 5 webinar and report that will be coming in the next few months. Thank you very much, everybody.